Hi, I'm Jose Armenta, and this is your Federal Employee Benefits, where we discuss topics aimed at helping FERS federal employees make smart financial decisions. Today, we're going to discuss how to figure out how much you'll need in your TSP to retire. So it's going to be a good one. If you're new here, make sure you hit that like and subscribe button so you don't miss any future videos. Okay, let's dive right in. Okay, so the best way for us to review this rough estimate, okay, is to look at an example, which is what we're going to do. Okay, so we're going to look at an example, and I'm going to use average numbers. So obviously these numbers will be different than your numbers, but just plug in your numbers and follow as you follow along, and you'll do just fine. All right, so let's get started. So for this example, okay, we're going to look at a federal employee, Bob. Okay, and the first thing we have to do with Bob is figure out what his fixed monthly income is going to be. Now, as a federal employee, your fixed monthly income is going to include your first pension, right, and Social Security. And so we're going to figure out Bob's net fixed income, okay, because the net, remember, the net amount is what's going to actually be deposited into your bank account. That's what you want to use when you're planning. Okay, so for this example, we're going to say Bob, his high 3 is 100,000. He has 25 years of service, and his pension multiplier is 1.1. Okay, meaning he is eligible for that 10% bonus. Okay, that 10% bonus, just in case you don't know, requires that you retire at least age 62 and have at least 20 years of service. So Bob meets that criteria. He's eligible for the 10% bonus, which is why his pension multiplier is 1.1. Now, again, if you are planning on having a 1% multiplier, then just plug in your 1% multiplier, okay? So after we do the quick math, 100,000 multiplied by 25 multiplied by 1.1, we get 27,500, okay? That's Bob's gross annual pension, okay? Now we want the monthly gross amount, so we're going to divide by 12, and what we get is 2,291 and some change. But to make things simple, we want simple numbers here for this example, so we're going to round down, and we're going to say that Bob's monthly pension is 2,290. Okay, that's his gross monthly pension. Now, we have to account for some deductions, okay? Now, you may have more or less deductions than this, but right, just plug in your deductions or what you're planning on having, okay? Now, for Bob, we're going to say that he elects a survivor benefit for his spouse of 50%, okay? So if you elect a 50% survivor benefit, the cost is 10% of your monthly pension. So the cost for Bob is going to be $229, okay? So we're going to deduct that from his gross monthly pension. We're also going to deduct $400 for FEHB, his health care. And we're going to deduct $350 for taxes, okay? Now, after we deduct these expenses, we are left with his net monthly benefit, which is what we want, okay? His net monthly benefit, which is $1,311. So his net monthly pension is $1,311, okay? Now, let's move on to his Social Security benefit, okay? His gross monthly Social Security benefit is $3,000, okay? $3,000, but we want the net amount. And so for most federal employees, your Social Security benefits will be taxable. And so for this example, Bob's Social Security benefits are taxable, and we're going to deduct, we're going to say that he's paying $200 in taxes, okay, on his Social Security benefits. So after we account for taxes, his net Social Security benefit, monthly benefit, is $2,800. Alrighty. So now let's add those two together to figure out what his monthly fixed income will be, his net monthly fixed income. When we add his first pension and the Social Security benefit, we get $4,111 of fixed income. Okay, so he can rely on this income to not decrease in retirement. It's only going to increase with cost of living adjustments. And so he can rely on the $4,111, okay, of fixed income. Now, what we have to do is compare what his fixed monthly income is to his monthly income goal. Okay, how much does he need to live in retirement? Now, for everyone, this is going to be different. And a good starting point is to look at how much you need to live now, okay? How much is your net income and how much are you spending of that net income, okay? So if if your net monthly income is 7,000 and you're saving 1,000 every month, then you may not have to account for that savings anymore, right? If you're saving for retirement, in retirement, you won't have to save for retirement anymore, right? So if you're only spending 6,000, then 6,000 may be a good starting point for you for figuring out what you're going to need to live off of in retirement. Okay, so for Bob, we're going to say his monthly income goal is 6,000. Okay, now if we subtract his fixed income from his monthly income goal, we get what's called the income gap. Okay, the income gap, how much is he going to need to pull from his TSP in retirement to fill that gap? Okay, so for this example, we're going to say that his monthly income goal is 6,000. We subtract the $4,111 of fixed income from his income goal, and what we get is the income gap of $1,889. Okay, so again, that's how much he's going to need to pull from his TSP on a monthly basis. Okay, now we want the annual amount. Okay, so we're going to multiply this monthly income gap by 12, and what we get is 22,668. So what that means is he's going to need to pull at least 22,668 from his TSP on an annual basis. Now, because I want to keep this example simple, we're not going to account for taxes, okay? But keep in mind that if you have all of your money in the traditional TSP, every penny you pull out in retirement will be taxable income, okay? So for this example, we're not going to include taxes on this 22,668, but that's something that you are going to want to include in your example, okay? So once you figure out what the annual amount you need to pull from your TSP is, you may want to increase that for whatever you're projecting your average tax rate to be in retirement, okay? So for this example, we're going to say that Bob needs to pull 22,668 from his TSP on an annual basis. Now the last step, okay, I know we've covered a lot of numbers here. The last step is to divide that 22,668, the annual income gap, the annual amount he's going to need to pull from the TSP. We're going to divide that by 4%, okay? Now after we divide that by 4%, what we get is the TSP balance that Bob is projected to need to retire, okay? So after we divide by 4%, we get 566,700. So Bob is projected to need 566,700 to retire, okay? He's going to need about that amount. Remember, we didn't take taxes into account here, so he's likely going to need more than this to retire, but he needs at least 566,700. So now he has a rough estimate of what he needs to retire. And that's how you can estimate how much you need in your TSP to retire. Now, although that's a great way of quickly getting a ballpark number, the truth is, to get a more accurate number, you'll have to do a deeper dive. Okay, you'll have to look at things like your current assets, liabilities, projected inflation in retirement, your current projected growth rate of your TSP, and projected growth rate of your TSP in retirement. So there's a ton to look at to get a more accurate number, but that's a great way of getting a ballpark number, all right? Now, one thing I did want to know is the reason why we divided by 4% is because of this thing called the 4% rule. It's a very helpful way to estimate how much you'll need to pull from your TSP in retirement. It was beyond the scope of this video, which is why I didn't cover the 4% rule, but I'm going to put a link to one of my articles covering it down below. Okay, so go check that out if you're interested. I hope you found this video helpful. If you did, hit that like and subscribe button. That's the best way to support this channel. And until next time, I'm Jose Armenta. Take care.